After a volatile week for gold and silver and the prospect of more volatility ahead, today we explore 6 key reasons which are set to see the Fed's balance sheet soar and send the gold and silver price up with it. So let's dive on in. Now, this channel provides global macro insights and champions the importance of sound money in a world gone crazy, so please do consider subscribing. Back in September 2019, the Fed once again restarted its process of expanding its balance sheet as the repo market tightened. Then in March, amidst big market declines, we saw the dramatic announcement of QE Unlimited. But since then, the Fed's balance sheet has remained fairly flat, yet this will not remain the case for long. So let's explore some of the key reasons why the Fed's balance sheet will soar and pull gold and silver prices up with it. Now, of course, gold has long enjoyed a strong correlation with the Fed's balance sheet. This chart highlights just that. In the last financial crisis, the gold price was pulled up by further expansion of the Federal Reserve's balance sheet. And in a world of negative interest rates, this simply reflects what is now globally synchronized debasement of fiat currencies. Now, the following reasons are based upon the analysis of crazed Capital's Kevin Smith. I'll put the link in the description. So the first reason why we're set to see an increase in the Fed's balance sheet is due to a stock market crisis. The Fed will intervene in order to support asset prices, and the greater the falls in the stock market, the greater the extent of the intervention will actually become. In March, the Fed's announcement of QE Unlimited saw the Fed's balance sheet thereafter reach over $7 trillion in size. Markets globally were bailed out by a massive injection of global liquidity, which helped to really bring up asset prices, which could well be triggered by a banking collapse in Europe, which we discussed in this video. Second, there is a growing need for the Fed to intervene to support the treasuries market. $8.5 trillion worth of treasuries will come due by the end of 2021, and a record budget deficit must be financed. At the same time, we're seeing many countries such as China divest their treasuries as a potential Cold War threatens. Now, this chart from Tavi Costa shows the declining percentage of ownership of marketable securities held by overseas treasury holders in red, and the subsequent increase in the need for the Fed to increase their proportion of treasury holdings in white. Many see such a trend as irreversible. Moreover, Danielle DiMartino Booth tweeted, "This is the most important tweet I'll send this week. The Fed so fears building disinflationary pressures, it's buying all the tips it can get its hands on in an attempt to force inflation narrative into investors' psyches. That is fear." Third, ordinarily a market-based economy would see treasuries begin to sell off and treasury yields therefore rise. Now, with the scale of deficits and national debt so high, increased borrowing costs would become unsustainable. In such a scenario, the free market would once again be curtailed in favor of central planning and control of longer-term treasury yields. Fourth, if unemployment remains stubbornly high, there will be an increased need for the Fed to actually increase their intervention. With every crisis, we inevitably see central banks increase their actual reign upon the economic system and act as our knight in shining armor. And so it appears to be the case once again, with the notion of the Fed coin, digital dollars, Fed bank accounts and CBDCs. Universal basic income, MMT, is the bribe to the people to allow further centralization of power and destruction of the banking system. And will this be in the longer term interests of the economy? Well, not according to banking expert Richard Werner, who recently tweeted, "CBDC means central bank current accounts, killing all remaining small local banks, and finally also their big ones. The Sovietization of the economy. The Soviet Union only had one bank the central bank. With only the Fed left as the only bank, there will be no economic growth. Fifth, if the Fed's measurement of CPI inflation remains too low, they'll be more willing to actually engage in monetary stimulus that firstly raises inflationary expectations and secondly may actually seek to increase the velocity of money. This velocity of money will then stimulate that higher inflation. Whatever approach is actually used here will go straight into the economy rather than simply contributing to asset price inflation. Sixth, President Trump has been a primary advocate of a weaker dollar, so any dramatic strengthening of the US dollar, as we saw in March, will require the Fed to actually intervene dramatically in order to avoid a dollar spike and the dire economic consequences which would be felt globally as dollar-denominated debts rise in real terms in those domestic currencies overseas. So what does this all mean for gold and silver? Well, currency debasement on this scale is enormously price supportive for gold and silver. What's more is that crazed Capital actually believe that the primary driving force behind higher gold prices is now the increased Federal Reserve balance sheet. Now, this is absolutely huge take in terms of the longer term direction for gold. And while of course there's going to be major bumps in the road in the shorter term, we're pretty sure where this outcome is likely to lead over that medium to longer term. Now, what do you think? I'd love to hear your thoughts, so do let me know in the comments down below. Thanks so much for joining me, and I look forward to seeing you next time. Bye bye.